Welcome to this comprehensive guide on multifamily real estate syndication, specifically designed for accredited investors who are targeting a 15% internal rate of return in the current 2026 market. In the world of high net worth investing, multifamily syndication has emerged as one of the most effective vehicles for building and preserving generational wealth, offering a unique combination of passive cash flow, significant tax advantages, and forced appreciation. A syndication is essentially a partnership where a group of investors pool their capital to acquire a large-scale apartment complex that would be impossible for any single individual to purchase or manage on their own. For the accredited investor, this represents an opportunity to own a piece of a institutional-grade asset while remaining completely passive, leaving the day-to-day operations to professional sponsors. To qualify as an accredited investor, you must generally have a net worth exceeding $1 million, excluding your primary residence, or an annual income of at least $200,000 for the past 2 years. The structure of a multifamily syndication is built on the relationship between two primary groups, which are the general partners and the limited partners. The general partners, often called the sponsors, are the active managers who find the property, secure the financing, oversee the renovations, and handle the professional property management. The limited partners are the investors who provide the majority of the equity. As a limited partner, your liability is restricted to the amount of your investment, and your role is to provide the capital while the sponsors execute the business plan. This structure allows you to diversify your portfolio across different geographic markets and asset classes without the headaches of being a landlord, as you are not responsible for dealing with tenants, toilets, or trash. When targeting a 15% internal rate of return, or IRR, it is important to understand exactly what this metric represents. Unlike a simple average return, the IRR accounts for the time value of money, reflecting the total profitability of the investment over its entire holding period, which is typically 5 to 7 years. This includes the quarterly cash flow distributions you receive during the hold and the final profit share from the eventual sale of the asset. To achieve a 15% IRR, sponsors usually focus on value-add opportunities in Class B or Class C properties. These are buildings that are well located in strong submarkets but are perhaps dated, undermanaged, or suffering from deferred maintenance. By investing in interior renovations, such as new cabinets, flooring, and appliances, as well as exterior improvements like fresh paint and better amenities, the sponsor can justify higher rents. This increases the net operating income, and because commercial real estate is valued based on its income, this forced appreciation dramatically increases the value of the property upon exit. The financial performance of a syndication is governed by a distribution structure known as the waterfall. Most institutional-grade syndications offer a preferred return, which usually ranges from 6 to 8%. This means that you, as the limited partner, are entitled to receive the first 6 to 8% of the cash flow before the sponsors receive any performance-based compensation. After the preferred return is met, the remaining profits are split, typically 80-20 or 70-30 in favor of the limited partners. This alignment of interests ensures that the sponsors are highly motivated to exceed the baseline projections, as their significant payday only comes after they have delivered a solid return to their investors. In many cases, a deal may also include an equity multiple target, where the goal is to double your invested capital over the 5 to 7 year term, which aligns perfectly with a 15% IRR target. A critical part of your due diligence as an accredited investor is evaluating the asset class and the market. In 2026, We categorize multifamily properties into three main buckets. Class of properties are near luxury buildings with high-end amenities and the highest rents, typically offering lower risk but also lower returns, often in the 8 to 10% range. Class B properties are generally 15 to 25 years old, offering a balance of stable cash flow and significant appreciation potential for renovations. Class C properties are older, workforce housing assets that offer the highest potential returns but also carry higher operational risks. Most investors targeting 15% IRR find the sweet spot in Class B value-add deals located in high-growth markets, such as the Sun Belt or the Intermountain West, where job growth and population migration continue to drive strong demand for quality housing. Beyond the cash returns, the tax benefits of multifamily syndication are a major driver for high net worth individuals. Through a process known as cost segregation, a specialized engineering firm identifies components of the building that can be depreciated over a much shorter time frame, such as 5, 7, or 15 years, rather than the standard 27.5 years. This allows the syndication to pass through significant paper losses to the limited partners in the early years of the investment. These losses can often offset the actual cash flow you receive, meaning you can enjoy tax-deferred or even tax-free income while the property is being improved. Furthermore, upon the sale of the asset, many sponsors utilize a 1031 exchange to roll the proceeds into a larger property, allowing you to defer capital gains taxes and continue the compounding of your wealth indefinitely. Risk management is the hallmark of a professional syndication. In the 2026 economic environment, sophisticated sponsors use conservative underwriting that includes stress testing for rising interest rates and potential increases in vacancy. You should look for deals with long-term, fixed-rate debt or interest rate caps to protect against market volatility. Additionally, a healthy capital reserve fund is essential to handle unexpected repairs or slower than expected lease-ups. As in law, you must also vet the track record of the sponsor, looking for a history of successfully full-cycle deals where they have met or exceeded their original projections. You want to see a team that has experience navigating different economic cycles and a clear, transparent reporting process that keeps you informed of the property's performance every month. The life cycle of a multifamily syndication generally follows four distinct phases, which are acquisition, renovation, stabilization, and disposition. During the acquisition phase, the sponsor secures the asset and they'll fund the equity. In the renovation phase, which usually lasts 12 to 24 months, the value-add plan is executed as units turn over. Once the property is stabilized with higher rents and improved occupancy, the cash flow distributions typically increase. Finally, the disposition phase occurs when the sponsor decides the business plan is complete and the market conditions are optimal for a sale, triggering the final payout to investors. In some cases, the sponsor may choose to refinance the property once it is stabilized, returning a portion of the original capital to the holders while still maintaining their ownership stake, which can significantly boost the overall IRR of the project. In conclusion, multifamily real estate syndication is a powerful strategy for accredited investors seeking a 15% IRR through a combination of quarterly income and long-term appreciation. It allows you to leverage the expertise of professional operators to access large-scale, tax-efficient assets while diversifying your portfolio away from the volatility of the stock market. By focusing on strong markets, conservative underwriting, and experienced sponsors, you can build a robust foundation of passive income that supports your financial goals for years to come. As we move through 2026, the demand for quality housing remains a fundamental driver of the economy, and those who participate in well-structured syndications are positioned to capture the rewards of this resilient asset class.